Now, in the middle of the GFC, we spoke of global economic volatility not seen for 80 years. Today, we speak of political volatility not seen for 80 years. And there is a connection. Big economic shocks have big political consequences. 1929 was followed by 1939.
One for Mum, one for Dad, one for the country.
And there has never been a more exciting time to be in Australia.
Dead, buried, cremated.
Australia's basically done for. We'll just end up being a third-rate economy. You know, a banana republic.
Just follow the money.
G'day, and welcome to Follow the Money, the Australia Institute's podcast demystifying the big economic issues in Australia and putting them in plain English. I'm Ebony Bennett, Deputy Director at the Australia Institute. 10 years ago, on September the 15th, 2008, the US investment bank Lehman Brothers collapsed, triggering a panic on financial markets around the world and heralding the start of what we in Australia call the global financial crisis.
Wall Street's worst day since 9/11. The Dow plunging more than 500 points.
What in the world is happening on Wall Street? Lehman Brothers has filed for bankruptcy and Bank of...
Who knows where this is going to end up? I mean, this is volatility we haven't seen, of course, since, 1929.
A 158-year-old firm filed for bankruptcy, brought down by bad mortgage investments.
People will lose their jobs, more people will lose their homes, people will have difficulty getting loans.
3 of the 5 biggest independent firms on Wall Street have now disappeared.
As the crisis quickly spread across the globe, Australia was one of few countries to dodge a full-blown recession. The federal government ended up spending in total $52 billion, that's right, $52 billion on cash handouts, tax breaks for small business and infrastructure spending as part of a stimulus package.
Good evening and welcome to PM. The federal government calls it an economic emergency.
The Government of Australia is today launching an unprecedented $42 billion nation-building and jobs plan.
It's a time to be bold and it's a time to get on with it.
The opposition will vote against this package in the House.
Spent the country's war chest for no immediate gain.
We remain prepared to take whatever action may be necessary to secure this nation's long-term economic future.
10 years later, the collapse of Lehman Brothers remains the biggest bankruptcy in US history, and the following crisis was the deepest global recession in more than 80 years, and some countries are only now beginning to recover. That's why in other parts of the world, it's called the Great Recession, not the global financial crisis. So what lessons were learned? How appropriate was Australia's response? What is the political legacy of the GFC, and could it happen again? To help answer these questions, the Australia Institute hosted a special press club panel discussion in Canberra with the then Federal Treasurer at the time, Wayne Swan, economist John Edwards, and The Guardian's editor Lenore Taylor, who wrote a book on Australia's response to the GFC titled Shitstorm. And just a quick note, this press club was recorded in August 2018 when Scott Morrison was still Treasurer and Malcolm Turnbull was the Prime Minister. Things change pretty quickly here in Australian politics, but at the time of recording, Scott Morrison is still Prime Minister.
Thanks very much. A lot of the memories, I think, have faded since the global financial crisis and those events of 2008 and 2009. For example, people now look a bit askance when I tell them the title of the book that I co-authored back then. My dear late mum had all manner of difficulty at the Bowls Club telling the other old ladies that I'd authored a book and then not ever mentioning the title. But at least that back then, when people heard the title, they remembered that it was something that the then Prime Minister Kevin Rudd had used to describe what his government faced. In fact, Kevin Rudd launched Shitstorm on June 21st, 2010. Wayne was there, and a lot of our press gallery colleagues came too, because just 3 days after that, Kevin Rudd lost the Prime Ministership. So in some ways, rereading this book ahead of today's events took me back to events that seem like a long time ago, but in other ways, it feels like nothing much has changed. I really just want to make 4 observations today that came to me looking back at that time and the research that we did for the book. The first one is that people seem to have very selective memories. Some people, particularly in the coalition, like to play down the idea or even sort of pretend like there was no global financial crisis in order to make the point that, Labor's not to be trusted with the economy. Treasurer Scott Morrison gave a speech to the Australian Chamber of Commerce and Industry late last year where he warned that Labor couldn't be trusted with the economy because the Rudd government had turned a $20 billion surplus into a $27 billion deficit in just 1 year, without any mention of why that spending might have occurred.
Because once you've run up a higher deficit over the next couple of years, that increases the debt and you can't get that money back.
So it seemed worth remembering via what we wrote in the book, exactly the positions that the coalition took in opposition in response to Labor's stimulus packages. They did, as we know, immediately support the first $10.4 billion stimulus. Malcolm Turnbull told us that decision was motivated partly by the spirit of the times. He said, "We thought we should cut the government some slack. They were making decisions in a tough environment. Secondly, the bulk of the money was going to pensioners, who we had been arguing should get a lift in their pensions. So given all of those things taken together, we decided not to oppose it." When the government proposed its second $42 billion package, there was some in between, but the second major package, in February 2009, the coalition did oppose it.
But we will vote against Kevin Rudd's $42 billion stimulus package. We believe it's too big at this time.
Malcolm Turnbull argued that it should have been smaller, that maybe $15 or $20 billion would have been more appropriate, and that it should have comprised in part but not in whole a bringing forward of already mooted tax cuts. He also conceded in an interview with us for the book that the decision to oppose the second stimulus was based on the calculation that it was going to pass the Senate anyway, with the support of the Greens, and that if it hadn't passed, then the coalition would have had to negotiate. So the argument between the major parties then was not about whether to spend, but rather about how much to spend and what proportion of the response should be tax cuts as opposed to spending programs. For the record, in our book, we concluded that with the benefit of hindsight, the government may well have been able to spend a bit less and still avoid recession because the economy did bounce back faster than anticipated, which meant that some of that second stimulus package was rolling out when arguably it was no longer needed. I expect Wayne will disagree with me on that point. And in any event, I think it's important to say, to remember that he and the other people in that gang of four that were making the crucial decisions didn't have the benefit of hindsight. They had to make the decisions in real time and in response to events that were unfolding in unpredictable and pretty cataclysmic ways. So I think, on this first point, the coalition can certainly emphasise the other things Australia had going for it as the crisis hit in comparison to other OECD economies. They had a budget surplus to deploy, room for the central bank to reduce interest rates. But the record shows that the coalition's response at the time, if they'd been in a position to do what they were advocating at the time, would almost certainly also have turned a surplus into a deficit quite quickly.
It is those children who will have to pay off Labor's debt.
And the second observation was that the bureaucracy back then had very clear advice to give. In the course of our research, my co-author, David Uren, discovered that when the government began asking the Treasury for advice about economic stimulus, the department was able to dust off an analysis that it had done after Paul Keating's 1992 One Nation statement, which had been the previous time that a government had to spend to get life back into the economy. That analysis had been done in secret in 2004 for obvious reasons. The Treasury didn't think it was a terrific idea to trumpet the fact that it was doing contingency planning for a possible future recession. And it had deliberately conducted that planning exercise when the economy was strong so that it could have ready advice and understandings to give to a government when and if a future crisis hit. It concluded that cash handouts had worked well, that big infrastructure spending was problematic because it often took too long to roll out. And that meant that when 2008 and 2009 happened, the Treasury had advice ready. And the government accepted the advice. They were also looking for double dividends, so in addition to sort of straight cash injections, projects that could get employment going across the country, create jobs. And that's where the home insulation project and education infrastructure projects came from, although there were well-documented problems in the practice of rolling them out.
For many primary school principals, The federal government's second economic stimulus package surely feels like manna from heaven. The package includes $12.4 billion over 3 years.
What's not clear to me right now is whether Treasury has done another analysis like that in the past 10 years. But it's not even entirely clear to me whether Treasury still holds the view that fiscal stimulus is the right way to go in principle. We know that the former Treasury Secretary John Fraser republished academic Tony Makin's long-standing critical analysis of the Rudd government's response. But we also know that the head of the Prime Minister's Department had previously criticised that same paper or that same analysis. So even before we get up to the differing circumstances now, it's not really clear to me what advice a government now would get from the bureaucracy should it again face such a crisis. And I find that kind of concerning because, let's face it, when these things hit, there isn't a lot of time to sit around arguing and figuring it out. So I hope for our sakes there was another secret planning meeting sometime in the last 10 years and they have got it all ready to go. The third thing that came back with sort of some clarity rereading our book was how relatively powerless we were as a nation state once that sort of global financial contagion took hold in the financial system. It didn't really matter that our own financial institutions didn't really have toxic assets on their balance sheets. If they had dealings with other banks that did, then we had a problem. It was a viral situation. It kind of swept over incremental national policy making. And so afterwards, there was a lot of consideration, as you would expect, by bankers and regulators around the world about what could be done to prevent this happening again. So to my mind, that means that we should be quite alert to the ongoing efforts in the US now to undo some of the regulatory changes that happened post-GFC. So the recent winding back of the coverage of the Dodd-Frank Act, or the plans to and push to wind back the Volcker Rule, the rule that prevented the banks from making financial bets for their own benefit rather than the benefit of their customers. I think it's in our interest to pay very, very close attention to those things, given the experience of what happened 10 years ago.
The crisis unfolded because Lehman Brothers and other big banks on Wall Street were propped up by worthless mortgage assets. Banks had invested heavily in these mortgage-backed securities, bundles of mortgages that were held by people who couldn't really repay their home loans. As a result, 9 million people in the United States lost their homes. 9 million people. US regulators refused to bail out Lehman Brothers as a warning to other banks, and they followed that up with tougher regulations under the Dodd-Frank Act and the Volcker Rule, with the aim of stopping banks speculating. But the lessons of 10 years ago are already fading, with United States President Trump winding back many of these regulations.
President Donald Trump signed executive actions setting the framework to scale back the sweeping Dodd-Frank Act and other financial regulations on Friday.
Today's legislation is the next step in America's unprecedented economic comeback. There's never been a comeback like we've made.
So we would again be in a circumstance where we had to potentially bail out the biggest of the big global planetary investment banks. It would be a real mistake to go backwards.
And my fourth and final observation is that policymakers back then didn't know the half of it. They were intent and very attuned to stopping the social and human dislocation of a recession. The dramatic increase in unemployment was really at the forefront of their minds. I remember Wayne talking about it at the time, about workers in their midlife who, if they were retrenched as a result of a recession, would never get a job again. But I don't think anyone then could have really foreseen the political dislocation of the past 10 years. I mean, politics often polarises after big financial crises, but I think this time the slow pace of recovery around the world from the GFC exacerbated that, and the fact that it happened right at the point of the huge digital disruption exacerbated it again, and the fact that it happened right when the media is in crisis, is in sort of existential crisis, exacerbated it again, and made the political ramifications bigger than I think anyone really anticipated. Australia's been shielded a little bit from that by having compulsory voting, by having a relatively stronger social safety net, but not entirely. We know that wages have stagnated, that income inequality has certainly not improved, that wealth inequality is on the rise. So we're not as far down that path of disillusionment with major party politics, but we're certainly headed in the same direction, and Lord knows they seem to be doing their very best to accelerate that process at the moment. But I think it underlines the need to retain and think about the right lessons from 10 years ago and to remember the important things. Kevin Rudd used that term shitstorm in a TV interview to describe the scare campaign that he knew was coming over the debt and the government borrowing he was about to undertake. But it's turned out that the shitstorm was a whole lot bigger than he could possibly have foreseen and much longer lasting. Thank you.
That was Lenore Taylor, the editor of Guardian Australia and co-author with David Uren of Shitstorm, a book that chronicles the Australian government's response to the GFC. The next speaker was the Treasurer inside that decision-making process at the time of the GFC, Wayne Swan. He warns of the political crisis that has emerged from the GFC, with rising income inequality and job security that has in turn fuelled a surge of populism in the West.
Thanks very much. 10 years ago, it's hard to imagine just how uncertain it was. We were looking at a situation of either going into recession or going into deep deficit. And we knew that we were staring down the possibility of a Great Depression Mark II. And I'd grown up with a Depression generation. My father's family have been scarred by events in the Depression. And I was acutely aware of what the Great Depression had done, its impact on politics and society, and the policy challenges that it posed for my predecessors. So Kevin Rudd and I took our responsibilities very seriously in this environment. And as it turned out, we were one of only 2 advanced economies to avoid recession. It was our timely deployment of monetary and fiscal policy that got us through the GFC. Elsewhere in the world, it's known as the Great Recession. Here, it's known as the GFC. So we came through by choice, not by chance. We avoided recession, the policy worked, and I think as a consequence, Australia has now enjoyed 27 years of continuous growth. So why is all this relevant now? There are still political outcomes from that period which are bouncing around economics and politics. Because what obsesses and frightens all of us today is political volatility of a type the Western world hasn't experienced since the 1930s. There's a ring of fire of nativist extremist political forces ascendant across the world and thriving in societies very similar to our own, United Kingdom and the United States. The fact that these forces exist in Australia should concern us all, but the fact that they are tiny fringe movements means that we have got something right. Now, in the middle of the GFC, we spoke of global economic volatility not seen for 80 years. Today, we speak of political volatility not seen for 80 years. And there is a connection. Big economic shocks have big political consequences. 1929 was followed by 1939. So if we fail to take the right lessons from the Great Recession and our response to it, we will expose ourselves to the full force of the next economic crisis. What made Australia different and what must we learn from this experience? Now, firstly and quickly on ideas. And I want to start with an admission. I've said a few times since the crisis that everyone active in economic policy making today needs to be asked this very simple question. Which of your settled opinions about how economies operate changed as a result of the GFC? And if the answer is none, you're either a genius or a charlatan. There are a precious few geniuses who can claim to have seen that crisis coming. For me, my approach to economics has changed. Whereas previously I regarded tackling inequality primarily as social policy, it is great social policy, but social policy first and foremost. I now regard it as absolutely central to good economic policy, tackling inequality. And I believe that viewing economics through the frame of inequality will give Australia a better economic result in the long run. The GFC taught us rising inequality isn't just an important moral challenge, something we tackle with the proceeds of growth once we can afford it and trade off for further economic growth later on. It is an economic challenge that determines how prosperous and stable our economy can be, and therefore it is of fundamental and central importance to the health of any democracy. And a decade after the GFC, we can see clearly that rising inequality globally isn't just making societies less fair. It's making economies less prosperous, less stable, more fragile and more crisis-prone. And it's having a similar effect on our politics. So the GFC hasn't just changed my opinion. Fortunately, in the 10 years since the crisis, the IMF, the OECD and other previous bastions of neoliberalism have executed nearly 180-degree turns in their policy prescriptions, from fiscal austerity to more active fiscal policy. Now to our second question. What made Australia different and what can we learn from that? The proof of our policy's success is in the industry devoted to attacking those policies. And that industry is still going strong after 10 years, and Lenore alluded to the actions of the previous Treasury Secretary in commissioning work specifically to attack Treasury work on the crisis. Any day of the week of the last decade, you can open a copy of The Australian on the Financial Review and you'll read a denunciation of active fiscal policy, or indeed any other crisis response other than surrendering to the cleansing fire of a recession. Hence, despite Australia's success relative to our peers, there's been a determined and publicly funded campaign to discredit the stimulus. They say it's unnecessary because of China, it was too big, or it had too little public support. Firstly, the miners were actually retrenching workers during the economic crisis at its height. Secondly, the ongoing pipeline of public investment from 2009 to 2011 supported our continuing growth as the world was shook by a whole series of events right across Europe and the developed world through 2010 and 2011. And then thirdly, a majority of Australians, a remarkable 62%, agree that the GFC would have sent the country into recession if Labor hadn't provided the large fiscal stimulus we did. Only 22% disagree. Now, you wouldn't get that impression if you were looking at much of the public analysis of what actually occurred during that time.
Another reassurance today that the Australian economy has fared better than most during the global financial crisis. Assistant Governor at the Reserve Bank, Guy Debelle, told a business conference that Australian financial markets have largely escaped the worst.
The Australia Institute also took a poll on the Labor government's handling of the GFC, and we found that almost 2/3 of Australians agree that the GFC would have sent Australia into recession if the government hadn't taken the action it did to provide a large fiscal stimulus.
What we avoided here was the capital and skills destruction that has been crucial to locking in the high levels of growth in Australia that we have achieved since the global financial crisis. And what it has meant is that unemployment in Australia has been consistently lower, and deficit and debt has been consistently lower than it would have been if we hadn't taken the actions that we did. By contrast, in the United States and Great Britain, the early withdrawal of stimulus and the inadequacy of the stimulus in the United States condemned these countries to a slower recovery and to higher levels of capital and skills destruction. So for me, the key lesson from these comparisons is that the avoidance of deep recessions improves outcomes in the labour market over an extended period of time. Now, the problem is I today doubt the capacity or ability of global institutions to respond as they did at the height of the GFC in 2007 and 2008, and that is a very big red flag for not only for the global economy but for political stability. I also have grave concerns about Australia's capacity to respond to the next crisis. They're partly economic, but they are largely political. While I believe that Australia could combat the next crisis, whether we would combat it would depend on which party was in government and what lessons they had chosen to learn from 2008-2009. In 2008, Labor was facing the choice between a recession and deficit. I fear then, as I fear now, that facing the same choice, the coalition would give us both. That's why the events of 10 years ago matter crucially for our national prospects today, and they will for many years to come. Thank you.
The final speaker at the Press Club is John Edwards, visiting fellow at the Lowy Institute. He was a principal economic advisor to Treasurer and then Prime Minister Paul Keating, and a former chief economist at HSBC, and he's also served on the board of the Reserve Bank. He's now an adjunct professor at Curtin University. And as John Edwards points out, the global contagion of the GFC spread quickly to Europe. But John Edwards warns that another GFC is possible and that it's China's increasing debt levels that should be cause for concern now.
Thank you. Well, let me just directly address this issue of whether the degree of stimulus in 2008-2009 was warranted. In 2009, US GDP contracted by nearly 3%. UK contracted by over 4%. Germany contracted by nearly 6%. Huge downturns. Over that year, the Australian economy expanded by 1.74%. Big contrast. And one of the big contrasts was fiscal policy, but it wasn't the only instrument we were using. It was also the case that the RBA, from August of 2008, began to cut the cash rate, and partly as a consequence, we had a much lower Australian dollar. So those influences were important. But I'm inclined to think the big influence, and the reason we stood out compared to other countries, was the swiftness of the fiscal response. Now, it's very hard to identify causes and consequences, but we can say this. We can say that of that growth we achieved in 2009 when comparable economies were contracting, of that growth, none came from mining investment. Mining investment was down. None came from dwelling construction or non-dwelling construction, which were down. None came from business investment, which was down. The big contributions of that 1.74%, the big contributions were 1.3 percentage points from household consumption, which was a major focus of the fiscal stimulus. 1.1 percentage points came from public investment, another objective of the fiscal stimulus. And 1.2 percentage points came from exports. And China had a lot to do with that. So it's certainly the case that China was helpful and exports were helpful. And they had nothing to do with the federal government. But if it was exports alone, we would still have been in recession of about 0.7 if we hadn't had that big hit on consumption and on public fixed investment.
Go hard, go early and go to households.
The Reserve Bank of Australia recently went to a bit more trouble to econometrically investigate the impact of the temporary tax break for investment introduced as part of the stimulus response. And what they found was the tax break had a strong effect on business level investment, and that the tax break was important on a macroeconomic level, and that GDP growth would have been lower without that temporary tax break for equipment investment. So it's difficult to prove anything in economics, but to my mind there's a very strong suggestion there that fiscal response worked and was appropriate.
The advice was the best thing you can do in the time available is to provide cash to households. And then the third bit of the advice was, if you think you need to do it, the quicker you do it, the better. Don't wait. Do it early.
The US had a downturn from which it has now recovered. The US is doing well. Per capita incomes are increasing. Unemployment is at a new low. Growth is okay. And as a matter of fact, seems to be strengthening. Investments picked up. The US is not in bad shape at all. However, it will never recover the loss it made in per capita income between 2009 and about 2017. It won't get it back because growth is not fast enough to recover it. It's also the case that in the US, debt to GDP, federal government debt to GDP is more than doubled to now over 100%, and it's going to keep going up under this Trump administration. And that does limit the responses it can make to a subsequent crisis. Wayne touched on the extraordinary changes to economic practice that have occurred as a result of the crisis, and they are truly astonishing. That is, the US Federal Reserve now holds about a quarter of US government debt, a practice which before was not inconceivable but very much frowned upon. That is, a central bank buying government debt as a matter of course and as a policy instrument, and continuously and in a big way, was adopted by the Fed in a huge way, and then adopted by the European Central Bank in a huge way, and by the Bank of Japan in a huge way. And only now, in the case of the Fed, are they starting to run it down. And the process of running it down is one that we'll need to watch for years. I think as a result of the GFC, the European Union and the Euro were put to an existential test, a test of whether they would survive.
The turmoil in Europe sent the Dow sharply lower.
Europe's largest economy, Germany, threw tens of billions at the problem last week. Now Britain has announced its second multi-billion-dollar economic rescue package.
And now Ireland, often referenced as an example of financial mismanagement, along with Iceland, along with Spain.
Because Europe could be pushed into recession by an Italian financial meltdown.
Whether the common currency would survive and that the euro would survive as an institution, and a lot of people were saying they wouldn't. They have. They've survived, and I think become a lot stronger as a result of that test. It's been an important outcome of the GFC. It's also the case that in 2013, as a result of the GFC, the purchasing power parity adjusted sizes of the US and China economies crossed over. In 2013, in this IMF measure of economic size, China became bigger than the US. And that's because post-GFC China ramped up. It was growing at 10% and the US was still contracting. So our world has changed considerably as a result of the GFC, changed somewhat here, but vastly more elsewhere, but in ways that affect us. So finally, let me just have a few thoughts about whether it can happen again. Can it happen again? And I think, well, there's no doubt it can. That is, we've had financial crises every 5 or 10 years over the last 40 years, and we'll certainly have more. The price-earnings ratios, the price-to-book ratios in the US don't look outrageously stretched. It's not evident that something's going to happen immediately, but it's a source of some concern. US government debt's a source of some concern. The same is true of Japan and Europe. But you can't easily identify something that causes a crisis of the kind we saw in September 2008. Nor, I think, can you in China debt, which is unsustainably high, which is continuing to increase. But it's occurring in circumstances where it's all denominated in domestic Chinese currency, and it's almost all held by Chinese domestic banks, and in circumstances where the Chinese central government is quite capable, if necessary, of bailing the banks out. That is, it's an intolerable situation, but it's difficult to see how it becomes a crisis. And finally, at the moment, Turkey. Turkey reminds us, as the Asia crisis did, in 1997, that countries which increase their liabilities in currencies other than their own, that have a foreign currency mismatch in their liabilities, are vulnerable, and they're particularly vulnerable if they've borrowed in US dollars and the central bank in the US is raising interest rates, as it has and will. I doubt we will see a global crisis emerging from there. But we will have it. Somewhere we'll have it. And I certainly agree with Wayne. It's wise to learn the lessons of the last event and prepare for the next. Thank you.
That's been episode 29 of Follow the Money, brought to you by the Australia Institute. It was recorded at the National Press Club in Canberra on the 21st of August 2018 with Wayne Swan, Lenore Taylor and John Edwards. You can find it on our website at tai.org.au. And there you can also listen to previous episodes of our podcast. And if you want to hear more about the GFC, go to episode 21, where we hosted a special discussion with the UK former Shadow Chancellor of the Exchequer, Ed Balls. You can subscribe free to Follow the Money on your favourite podcast app. We're also on Twitter at the Oz Institute with an AUS. My Twitter handle is Ebony_Bennett with a NNT. Wayne Swan is at SwannyQLD. Lenore Taylor is at Lenore Taylor. This episode was produced by Jennifer Macy with additional editing by Lizzie Jack and Renee Sant. Our theme music is by Jonathan McFeet from Pulse and Thrum. You can find more of his music at pulseandthrum.com. Thanks for listening.